What's going on with the momentum in the markets, particularly the silver market? Michael Oliver from Momentum Structural Analysis joins us today in this episode of Silver Bullion Television. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Michael Oliver from Momentum Structural Analysis joins us today. Michael has a wealth of expertise and knowledge working for decades at high level positions in the financial and commodity space. And we're delighted to have Michael join us once again today. It's time to saddle up and silver up for Michael Oliver. Michael, welcome back to SBTV. How are you doing?
Good to be back, Patrick.
Glad to have you back. A lot's been going on since we last had you on, but I noticed one thing, and I forgot to ask you the last time around. I believe you coined that term anarcho capitalism.
Yeah.
Yeah, can you tell us a bit about what that one is?
Okay. Well, originally I was headed toward political philosophy as a professor, and I quit in the middle of a PhD program. But for my master's degree, I wrote a paper I created a term called anarcho capitalism. At least I did about the same time as a friend of mine did, Murray Rothbard, who is deceased now. He's in effect, the intellectual head of what is now anarcho-capitalism. He was an older man then. I was in my 20s. He was in his 40s or 50s. And I interviewed him for a newspaper I had. Now he's the key figure as the person who brought this into being. We now have a president down in Argentina who's self-declared not libertarian, but anarcho-capitalist, meaning I want to dismantle this thing ultimately. So it's actually taken hold, but the term, Rothbard wrote an essay on it, but I wrote this thing on it, and I corresponded with him, and I've got the letters, and he praised it and said, "You'll be the first one to have written on this subject." That's good. This was back in 71, long time ago. God, I was in my early 20s. Anyway, it's now on Amazon. It's the most popular book under paperback libertarianism. So I'm getting rich. No, I can only buy beer off the rewards. Anyway, but it's an intellectual defense of the concept based upon emerging of Ayn Rand's philosophy minus her politics. Her politics was simply basically what you'd call founding fathers' limited government notion. Okay, very like a conservative, more or less traditional in that regard. I removed that and replaced it with Rothbard's, who was an economist, economics and his politics, which was, we don't need the state. Okay, now, not that you're going to go overthrow it or anything like that. It'll evolve away over time, because if it's a bad idea, the concept of monopoly control from above, then it's dysfunctional. Ultimately, its a dysfunction will reveal itself this way, that way. Sometimes it takes decades. So far, it's been going on quite a long time. And it doesn't seem to really get better. Just like the government debt ratio doesn't seem to get better, no matter which party wins. Anyway, so I'm not focused on that. I'm not involved in the movement or anything like that. But yeah, it was something I did decades ago. And it's interesting to see probably something like that is happening, where at least some doubt is sweeping the earth in a lot of places, not just the U.S., about, hey, this institution isn't quite functional. It doesn't seem to ever do what it says it'll do. It always seems to hurt me in some way. And I think a lot of what Trump has promised is simply not going to happen. I think one thing that's going to blow up in his face is he's going to have commodity price inflation big time, whether he wants it or not. And then that some people will look at that and say, well, gosh, I voted for you thinking you're going to keep this down. Anyway, and a lot of other things. Tariffs are nothing but taxes, for example. So he's against taxes in this regard, but he's for them. Now, anyway, I'm not involved. I don't allow that to get into my work, our momentum work. Although there are times I see that when these macro events that we just chatted about come into play, they can, in fact, have impact on markets. And I think we're at one of those points right now.
Yeah, I just found it interesting because it seems like the way we unfold throughout time, there are these little elements of that also coming
Yeah.
into play here and there. If you don't mind, let me start off with asking you about the economy. It's strange. We see markets up, we see the dollar a bit down, we see precious metals moving up, oil on a 3 year downward trend despite wars and tariffs. We see an administration wanting lower rates and the Federal Reserve, their central bank, wanting higher rates. Michael, how do I assess this? Is this par for the course?
Yeah, it's as far as what government does or doesn't do, that pretty much doesn't matter. There's a reality bigger than that. Okay. And a lot of people think markets go down because something happens. Most markets, when they go down, have big bear trends. It's because of what already happened, built up over years. And the market is expunging itself of that error, overpricing error, assumptions that were false errors. And we've had the biggest bull market in US stock market history from 2009 to 2025. And it was led by the tech area. NASDAQ 100 went up 18-fold in 15 years. S&P went up about 8 or 9-fold. So clearly NASDAQ 100 tech sector was leader. But you say, well, that was a good, strong economy. Well, of course, Trump would admit that because most of the presidents during that time were Democrats. So you look at an M2 chart, Federal Reserve money supply. It's vertical, okay? And basically any 10-year period you pick going back to the 1950s, the money supply went up 90 some odd percent, almost doubled in quantity. Okay, that means given the greater quantity, it has less real buying power. And sure enough, since I was a kid and a loaf of bread was 20 cents, now it's, 10 times or 15 times that. Is it because we have a wheat drought? No, it's because of the ongoing degradation in the real value of the money units, not just dollar, but euro, yen, you name it. So that's a major factor. And these things are in play. So as far as the economy goes, I think we're at one of those points now where the bubble is starting to break, stock market. We gave a sell signal for the S&P in early January. That was just short of a high it made in February, and then it dropped hard into April. We know that in any trend, there are counter trend rallies. But when it was on its way down to 4,800 price level, which was our target for a bounce, not a bottom, a bounce. The bounce has been bigger than we thought it might be because it went up and made a new high. But that was a level where we thought there would be support, and lo and behold, the crowds came in. We point back in our reports recently that we've been around since 1992, but in 2000 dot-com top, MSA called the top in January. But golly, if you look at the price chart of the S&P, it made higher highs in March after we said sell in January. There was a sharp drop, then it came back up in March, and it labored all year, comfy, either side of our get out point. Finally, in 2001, it started to cave, and in 2002, collapsed. In fact, the NASDAQ went down 82%, a near wipeout. Okay. Then 2007, another arduous top. Close of 2006, the S&P was about 1350 in price. We projected that it would go higher in next year into 2007, and we had a target for a top. We defined it as 1550 to 1600. Now, I'm throwing out numbers here. Let me tell you what those are. 1550 was the old high that the market had made in the year 2000. So it was at 1350. We said, we're going to go back to the old high. We're going to take it out. And that's where you're going to top. Well, in May, we went up over 1550 by about 2-3 points, matching the high in 2000. And they sold it. Sharp sell-off into the summer of 2000. This is all during the building mortgage crisis that was increasing in its lethality. Okay. Not recognized by the Federal Reserve, but nevertheless, it was going to happen. Then in September, the Fed cut rates. September 2007, right in the middle of the month, was a surprise rate cut, 0.5 point. Even though Bernanke back then said, no, No problem with the mortgage market. It's under control. Well, why'd you cut rates then? Okay. Market went up into October, stopped at 1576, precisely in the middle of our target zone. That was it. Next 2 years was hell. Okay. Arduous. In other words, tops in the stock market are often very time consuming and teasing. Often with, even once momentum breaks, prices, no, I'm going to go for more. It doesn't, but it makes that new high. I think that's exactly what we're doing now in the U.S. market, is we've teased out the high of early this year. And by the way, if you look through the market more carefully, not just the S&P or the NASDAQ, many sectors, many key symbols, including the Mag 7, aren't making new highs. A couple of the Mag 7 are, but most of them are way off the highs now. So the leadership has been decimated. And it's not exactly what the S&P and the NASDAQ charts seem to be saying. We think it's the top. It's important for silver and gold. Because when that money flows out of there, and it's already begun to, seeking an alternative place, monetary metals will be the prime area. Gold is already reflecting that, and we think that silver is about to take control and vastly outperform gold. And probably much of that you're going to see in the next 5 to 6 months.
It's interesting you say that because with the Nasdaq 100, you pointed out actually 5 key points where the last we had a high, then 0.1, a low 0.2, a high 0.3,
Oh,
a low 0.4, and then we had a high 0.5 again. But this time it's different. You're feeling this time is different.
Well, now see, there's a price chart pattern, and we look at price, but secondarily, because quite often price is teasing, meaning it might do something that looks like a breakout, but it's not. It's a coin toss. And a lot of people say, oh, that's a breakout. Well, if you look at the NASDAQ 100 or S&P over the last year or so, year or two, you've made a high, the recent one. You made a low in April. You made a lower high back in January, which you've now exceeded. You made a low in August of 24. But you've got this, what the Edwards and McGee, this is an old classic book on technical analysis of stock market trends, it's called, written in the 1950s. It's about 400 pages thick and fine print. And I bought it in 1975 when I was with E.F. Hutton, the future side of the market, and to learn about technical analysis. It's just price chart stuff now. MSA is beyond that. But right now, momentum says you're broken. Price says, hey, I just made a new high. But it happens to be a price topping pattern that Edwards and McGee defined decades ago called the broadening pattern, broadening top, where you make a high at number 5, you make a low at 4, 3, 2. It's widening, but you've got 3 distinct highs, each higher. It's a broadening pattern. And so every time it makes a new high, you think it's going to launch, and it doesn't. Once you get to that third high, which we're now at and starting to roll over a little bit today, that is your final high. And we've got some metrics on momentum that will tell us, yep, that was the final high. So we think when that market breaks, it will be a glacial mover. One, it will panic the central bank because the data points will follow the market down. It will irritate the hell out of the president. And he'll be banging on Powell's head. But it will change a lot of things. It will cause money flow. And when money flows out of the stock market, it's traditionally moved into 2 places: treasury bonds and gold, and related to gold, silver, for example. This was true in 2000, 2002, 2007 to 2009. And it's been true lately. You'll see gold has gone up while the stock market has done this broadening pattern. Once you punch the hole in the stock market to where people start to realize it is broken, that money will flow even more aggressively. But the problem is T-bonds aren't behaving this time. T-bonds are a problem also for the government. Their own debt, not private debt, their own debt. They got a noose around their neck. So we were left with really monetary metals as the only viable alternative. And I think at this point, we're about to launch a more aggressive upside between now and the end of the year. But I think silver and gold and silver miners will vastly beat gold in the next 6 months in terms of percent gain.
Well, you were part of EF Hutton, so not to get too cheesy, Michael Oliver talks, people listen.
You remember that?
Yes, I remember those commercials. I spoke with David Morgan a few weeks back, and he mentioned momentum and how you are seeing momentum with silver. Can you give us your take on I guess really what is driving the momentum with the silver price?
Well, it ran up last year in 2024, early in that year in March. We put out a major renewed buy signal on gold and silver and the miners. Renewed meaning that for prior couple of years they've been in pause mode. Silver and the miners had been staircasing down in corrective mode. Gold was going sideways, basically, capped at around 2000. We said back in March of a year ago that we're going to take off again. And sure enough, they did. Okay. Silver actually at one point in that rally outpaced gold pretty nicely, but it didn't last, okay, in terms of relative performance. Silver ran up in May of 2024, in other words, a handful of months after our signal, and got up it was at our time of our signal, it was $25, $26. It got up to $32.70 a year ago in May, okay, and dropped from there. Came up later in October, got to $35, new high. Gold was going sideways during that time. Dropped again, went back up in March of this year again to 35. And that's when they had that panic sell-off into April, where investors wrongly thought that if the stock market goes down, silver must go with it. Gold didn't drop much during that time, but silver was punished severely. We know that. Went from 35 to 27.50. Much of that in 2.5 days. Then it exploded right back over 30 and has worked its way up. Now we're at 37, either side of 37 for the last several weeks. That process in price, where we basically, you could draw a line sideways from May of last year through a month ago. We've been above it and below it, but basically just violent oscillations. So it was really sideways. That was a corrective pause in price. And for momentum, our long-term momentum, it had a corrective pullback, where on the momentum chart, you could see a tube, where momentum readings just kept zigzagging but downside in this very clear technical tube, parallel channel. In June, early in last month, we crossed up through that momentum channel. Price wasn't making a new high. Wasn't back above the 35 level. But in the 34s, momentum said, I'm out of here. Boom. Got up to 37 now recently. So it's broken out. That is the beginning of what I think is likely to be a couple quarter long, 5 or so months of upside, and likely to be very aggressive. Similar behavior occurred back in 1979 when silver exploded to 50. Also in 2010, the $25 to $30 level before silver exploded to 50 again. We argue this time, this breakout will render highly likely another aggressive move, but one that will not pause at 50. We think this one is going to get its first pause in the 60 to 70 zone, well above the old idiot highs. I call them idiot highs because really you didn't spend any time up there. It was like phantom. It was like a day or two. Thin air. I think by going through 50, which is not technically important for us, but it is for anybody looking at a stupid price chart, it's all-time new high. In real dollar terms, if silver were to match those $50 highs, it'd probably be $300 an ounce in real dollar terms, underlying decay in the money unit. But I think that's likely to occur in the next 5 to 6 months, that phase of it. That is not the end of the bull. That's just the next thunderbolt. And during that time, I think silver will basically double in relative performance to what gold does during that time. Silver is definitely going to be the better place to be.
Oh, lot to unpack there. Good info. Good info. Interesting because I would say currently, we see silver 37, stays there for a short while, goes in the 35 range, stays there for a short while, gets back to 37-ish, stays there for a short while. So we see that uh, oscillation, that volatility, if you will. And with the upside and how we're talking about momentum here, do you see anything that could cause a significant pullback? Because with gold, we never saw any significant pullback during its run up, but with silver, we're really seeing this anchor just trying to weigh it down.
Yeah, no, I don't think anymore. I think that occurred over the last year, as I explained, from May of last year up through June of this year. There was this momentum corrective process. And if you saw our charts, you would see what I was talking about. Momentum was revealing something that you couldn't see it on a price chart. On price chart, you saw erratic behavior that seemed to be trendless, yet net on balance, it was really sideways, either side of about $32, up, down, up, down, up, down. Momentum was building a structure, what we call a structure, meaning a definable chart pattern, in this case, a perfect parallel channel that spanned an entire year when momentum was correcting from pretty high levels down to neutral levels. And then it said, okay, out of here. And it's out of here. So I suspect basically about every month going forward, we're going to see silver dramatically higher than the prior month. And I think we're not going to pause at 50. Anybody who's waiting to sell it up there again, I think is going to get bulldozed. But I think this is not a behavior pattern that's unusual for many markets, not just silver, where after a lengthy upside where there's been arm wrestling a lot of the way, up and down, confusing a lot of people. These things happen. That's reality. Markets ebb and flow. They have waves of profit taking. The question is, which one is real, meaning sustainable? None of them have been for silver. None of them have been for gold, sustainable on the downside. Even that collapse we had in April, which took it from 35 to 27.50, was back up in the 30s in a heartbeat and in new highs within a month. Okay, so you've got, if you're invested in silver, don't look at the day-to-day stuff. Even looking at price itself can be delusional, but at least look at the longer term trend and you'll see what I'm talking about, that this arm wrestling process doesn't go on forever. And most bull markets, you get a point where you go whoosh, and people are shocked by the sudden change in the demeanor of the market. It's not what they expected because they've been trained by the market action prior to expect this continued doubt process, going up yet in doubt. And then suddenly there's a jolt, and if you're not there, you miss it. And because it won't give you opportunities to enter. As far as we're concerned, basically all the opportunities to enter are well below us. But you better get in soon, because if we're correct, and I think we are, you're going to see this type of action, which will be surprising. And I bet it's correlated to certain other markets doing certain other things.
Okay, yeah, because I was going to ask, as you said, we seem to always be looking at price. You're seeing momentum. So I guess my question, and forgive me if you may have answered this, what what are the elements that make up momentum? Should I be looking at maybe one or two things, or is this a trade secret that we have to subscribe for?
Now, there's a philosophical sort of, not, there's a theoretical reason why momentum is better than looking at a price chart. First off, realize price is deceptive because the thing you're measuring by is a money unit, a fiat money unit, not backed by anything but BS. Whether it's the yen, the euro, dollar, they're all backed by nothing. Okay, government at the push of a button can increase its supply, artificially lower the cost of money, interest rates. And for the last 15 years, 10 of those years, we've had zero rates, free money. I mean, how hallucinogenic can you get? Okay. And so it's a distorted yardstick. So if you're measuring something with a yardstick that is changing in real value year to year, especially every decade to decade, it's distorting the price reality. So you're looking at price is not the thing you're looking at, it's the distortion in the money unit could be more of a factor than the actual asset you're looking at. Okay. Now, how do you factor that out? Well, you can't really, because you measure it by $1, let's say. What we do is we take the momentum, meaning the dynamics of the underlying asset as measured by dollars. Many markets are dull. They're just going sideways. No momentum at all. They're just, up, down, trading range type thing. Strong markets or weak markets will often have sharply rising momentum dynamics or weak momentum dynamics. That factor, by using the momentum of the asset, even though it's somewhat distorted by the money unit, just like the price of the asset is, removes you a half a step away anyway from simply measuring by the money unit itself. You're letting one of the attributes of the asset do the talking. Okay. And when you plot momentum, meaning you oscillate the price action in relationship to a given moving average, let's say, long-term or short-term average, you'll get a different visual picture of that market quite often than you will when you look at the price chart. And almost all the time, at a major top or a bottom, momentum will have warned you ahead of time clearly in a way that smacks you in the face if you had the opportunity to see a momentum chart at the right time. We don't use the wet noodle indicators. Those are the things like MACD and RSI, which are on everybody's screen for free, part of the package. Ours are more bar chart oriented, like you would look at a price chart, but they're momentum based. And again, we're looking for structure on the momentum, not whether it's just going up or down. You can have an up move in momentum that's not bullish. It's just an up and a down pattern. Okay. We look for structure, just like a price guy would. Is there a trend line? Is there a ceiling? Is there a floor? And if you're breaking it, because then momentum is saying, hey, I'm changing trend. And lo and behold, you look over at price and maybe it's not. Soon thereafter, it is. Okay. Price usually follows momentum. That's what we do.
Yeah, I'm one of those guys looking at the MACD relative straight index. One of those guys.
Yeah.
So yeah, I'm looking in the wrong place. Hey, interesting how you're looking at silver doubling up because with platinum, um, only since April it's getting fairly close to doubling up as well. So with platinum, I wanted to know, is this, since it's only 3 months, is this more pent up energy or more, let's just say, momentum?
Platinum, a lot of people like to connect it to gold, and I think it's a great error. First off, you could overlay a long-term platinum chart with gold, and there's almost no correlation. There have been times when, yes, it was going up with gold. There have been times when the commodity complex is going up with gold or even going down while gold's going up. For example, during 2015 to 2020, the Bloomberg Commodity Index, platinum too, were under pressure. Gold doubled during that time, while commodities were going down. Then in late 2020, when gold had already made its high in the mid 2020 level, 2070, I think was its price high in the middle of the year 2020, commodities started to explode. And yet gold didn't during that time. I think now the commodities are about to get back in sync with gold. Now, this happened back in the late 70s. It also happened in the 2008 period, 7-8 period, where commodities exploded along with gold. And I think it's about to happen again. Platinum is behaving more or less like the Bloomberg Commodity Index. It tends to inhale and exhale more in sync with the broad commodity category than it does with gold or silver. And I think platinum is not just the only one that's reasserting itself lately. Copper, all-time new highs now, was down, mucking around $4 over the last 4 or 5 months. It's now over $5 again, all-time highs. So it's not just those two metals, but there's other stuff within the commodity complex that we're looking at that is ripe for a major upturn, including crude oil, which is right now the weakest of the components in the commodity complex. And today was very, very interesting. I don't know if you knew this, but the OPEC is going to increase production in a surprise amount. They announced they're going to increase, but in a surprising amount. I thought, well, they'll bash the heck out of oil today. Well, they tried to. Last I saw, it was up on the day. So even it senses it doesn't matter. There's something bigger going on here, a broad commodity upturn again. Right now, crude oil is in the upper 60s, mid to upper 60s. WTI crude. You get up to 70 on a monthly close anytime during this quarter and bet on it. It's gone. It's going up. It will join the Bloomberg, and we'll have a broad commodity upturn, which will be on the heels of what gold's already been doing. Will also upset all kinds of notions about government policy, which again is part of what we were talking about earlier, a sense of what the heck's going on.
Yeah, I was going to ask you, is this in part because of, let's say, the mistrust or weaponization of the U.S. dollar? Is it maybe even on the DXY we see the dollar, heading down a bit?
Now, the dollar index was a dull market between 2023 and 2024. If you look at a chart of it, it was like in an 8% range, meaning against the euro and the yen. That's its main components. Okay, just ho hum. So while other markets were fairly dynamic, it was dull as heck. We labeled it the quiet one. Watch out for the quiet one. Okay. March of this year, it was 104.21 on the close. We said, that's it. It's a bear market. Okay. It then dropped down to 98, rallied, with the stock market, by the way. It dropped with the stock market during that time. Then it tried to bottom in April and turn up just like the stock market. Dollar rallied 4 full points back to 102 area. S&P continued on up. The dollar's now rolled back over and making new lows down in the 96s. We think the dollar index is now so broken on very long-term momentum that it's highly likely in a major wave down that could challenge the last major low of a decade, 15 years ago, at the 70 level. It has not been a wave creator between 2023 and 2024 because it was so dull. Nothing was going on. All of a sudden now it's become a noisemaker, and it's impacting people because if you're a foreign investor, for example, and that you bought into the U.S. stock market some years ago, we've learned that over the last several years, foreign investment in the U.S. stock market is at highest levels it's ever been. Or you're a major foreign investor in U.S. Treasury bonds. Well, it's not just the price of those assets that you care about. If all of a sudden the dollar, which is what you had to buy them with, converted your currency and bought them with dollars, if the dollar is getting kicked 10% or something, then that adds to the negative situation. So that could be a wave impactor that hurts the S&P. And I know we had in the weekend report a chart showing this, but a lot of people assume that if you have a weak dollar, that'd be good for the stock market. It is historically the total error. Dollar index bottomed in 2008 and has been in a zigzag uptrend since. S&P bottomed about 4 or 5 months later in 2009. There's been an upward zigzag process since. They're much in sync. So as the dollar breaks, it could be a fuel injector to a downside in the stock market and an upside fuel injector for the monetary metals.
How about tariffs? Do you see tariffs? I mean, the continuation of these tariffs moving the needle anywhere?
It's a factor, I'm sure, but again, it's a new factor. And don't assume that if the market goes down, it's because of tariffs. Markets always get stories after a top or during a top that only just then occurred. But the reason for a major bear market is almost always what occurred before that shouldn't have occurred. Some sort of excess. The dot-com bubble, for example. When the S&P went down 50% between the year 2000 and 2002, NASDAQ 100 went down 82%. Wow, it's a wipeout. And yet everything that they told us at the dot-com top about how good the internet was, what it was going to change our lives forever, was right. In fact, it was understated. And yet it still went down 82%. Why? It got overvalued too quick. This time we have multiple factors in play. The distortion in the money unit's been even more, and money supply growth. Artificial rates for 15 years, way below what any market would have offered. So people made decisions based on free money. A bad decision. All of a sudden it's due. A lot of people are choking when T-bonds sit there. High yields stay there. They're choking on it. That's coming due. Watch commercial real estate, we argue. We've been arguing that for some time. Don't keep looking at NVIDIA. Yeah, it's going to top too. It looks like it's topping to us. The process. In fact, it's really gone nowhere for about 2 years, if you look at it, year and a half anyway. It was over 140 back in 2024. It's 150 something now. Wow, big deal. It's been either side of that number. But anyway, these factors are coming into play now. And I think that's further dynamic underlying the upside in the monetary metals, which is going to hit with a jolt. No longer this, let's go step by step. All of a sudden, it's white knuckle flight, and people who aren't in it have to chase it. And that's quite typical in many bull markets at some point, usually later on.
Yeah, I took a quick peek at your July 6th report also, and even T-bonds, it was labeled as not very dynamic.
Yeah, T-bonds you mentioned?
Yeah.
That's a real threat because it's too key of a market. It's bigger than the stock market, first off. Okay. It ain't getting better. Okay. You've had a drop in yields a year or so ago by the Fed, but rates, and then they rose rates. But T-bonds have basically stayed at high level of rates since 2022. Prices laid in the floor. It's tried to make a bottom. You could see it on a price chart. And we even thought on momentum you could get a decent rally, a counter trend rally, but one that would temporarily behave as an alternative to a doubtful stock market. Back in late last year and into early this year, it started to rally. It went from like the 114 level up to 121. This is long-term T-bond futures. Nice rally. When the stock market collapsed, it collapsed to 111 in a matter of about 2 days. When the T-bond market drops that much in a couple days, something's wrong. That's not normal behavior. And even though the Fed doesn't talk about it, they got to be really concerned about the illiquidity, the failure of that market to provide any help to anybody in terms of less choking rates. And therefore it's a market to watch. But lately it's been stuck in a range, so it's really not doing anything. But the thing it's not doing is recovering, dropping yields, raising the price of the bonds. That failure to rally is choking and choking and choking as each month goes by to debtors. And we think there's a potential here. We're trading in the 113s right now. You get back down to 110 again, there could be some kind of rapid implosion, something that creates headlines. So that this effort to base bonds price-wise, yield-wise to cap it is failing, and instead you spike lower in price, higher in yield. You can imagine the upset effect that will have on the stock market and the central bank. Beneficiary, monetary metals.
You know, Michael, I appreciate all of this. I've been doing this for a while, and you're probably one of the first that actually laid out the stock market, the T-bonds, the dollar itself, and painted a very nice picture of how, you know, metals really are the place to be. So I appreciate that. And thank you. Thank you very much. And but before we head out, I want to ask you, how can the people follow you, and where can they see you on social media?
Our website is olivermsa.com, Oliver MSA for Momentum Structural Analysis. We explain our very unorthodox methodology, not in total detail, but enough to give you a sense. Many archived reports, major tops and bottoms in markets. And, you know, take your time, tool around, and you can request sample copies.
Okay, so we'll be looking for that silver to double up and gold to continue the momentum. I mean, it all looks good. So, Michael, thank you for your time, and I hope we can do this again soon.
Thank you, Patrick.
That was Michael Oliver sharing his views on the momentum of markets. To see more of Michael's insights and work, head on over to www.olivermsa.com. If you like this interview, please do subscribe and give it a thumbs up. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.